Welcome to my YouTube channel. My name is Phil Grande. The unfolding of the market crash. We have some tremendous evidence this week. What a crazy week it was. Let's take a look at the 10-year chart. You see this red line right here? This red line goes up. That's called a trend line. But notice how nice and tight this stock market stayed in that trend line all the way from 2011 to 2015. But something then happened. What happened? Well, all of a sudden we started to see a blowout. See, the market was blowing off its trend, blowing outside its trend. That's very, very negative. And then it kept doing that all the way up. Look at this. That shows a very, very weak and unsettling market. And then we paid for that right here with the biggest market crash, unbelievable, fastest market crash, down 35% in 22 days. Wow. But then something really strange happened that gave us the biggest clue ever, okay, that the market is nearing a crash. You see this black line right here? That represents the S&P. But something really strange happened. As the stock market was going straight up, so wasn't the housing market. They're going up together. When they go up together, and you have a history of all this weakness back here, something is wrong. And I'm telling you, when they spike together, I've seen this happen almost every crash. It's one of the biggest signals that you can get a spike in both the market and housing. But the evidence back here is showing you something was terribly wrong. But look what we went from blowouts. This is crazy spike remember, we went out of trend. It went out of trend. Here's your red line. There's your red line. And it went out of trend. So what happened? It's called monetization of debt. Debt is what drove this. Now, what's that mean, monetizing the debt? Well, it's financial engineering is what it is. And let me explain. Okay, first of all, to have a good economy and stock market, you got to keep things in balance, okay? Now, what does that mean? Well, you want to have the amount of goods that you produce right here, let's say 50%, and the amount of money supply at 60%. That is a very good balance. That means everything's in order. Everything's wonderful. But what happened? All of a sudden, we started to see a big spike. Look at this. Look at the big spike in money printing. Well, let's go back to 2008. Remember QE? All that was the government would go in, or the Federal Reserve would go in and buy the treasuries or the debt from the government. Remember, every time you buy a treasury, it goes on the government balance sheet as debt. So as the debt keeps climbing, they have to get rid of that debt to keep interest rates down, because if the Federal Reserve didn't come in and buy this and move it over to here to their balance sheet, the Federal Reserve, that means they could not keep interest rates down. If they didn't do this, interest rate, the more debt they have, all of a sudden they'd be paying 10, 15, 20, 30% interest like back in the 1970s. So the key is for the Federal Reserve, the more money that the government borrows from you and me as a treasury, it's imperative that the Federal Reserve buys that treasury, shifts it over here. But there's a big problem with that. Deal. What it is that it's sending a message to our Congress to spend all the money you want. There's no restraints, because no matter how much money you spend, we're just simply going to go and buy all that debt as a result of your spending on stimulus and everything. We're going to keep monetizing it. We'll keep on going and taking the debt, and we'll shift it over here so that you can keep on spending, and we'll keep buying. You spend, and the debt keeps going. We'll make sure we keep the debt down. We'll keep monetizing it by keep spending it over here. You spend, and we'll move it over here so you can spend all the money you want. Why is that? Because the rich wanted to make sure that we had a lot of debt, so it helps the market go up. What do you mean? Remember, with all this printing of money, remember what happens. You have tremendous inflation. And with tremendous inflation, you have also the dollar going down. Okay? So when you have a weak dollar, okay, that's good for the stock market, right? The weaker the dollar, the stock market goes up. So that's what they've been doing. But there's a problem with that. All of a sudden what happens is you're out of sync, meaning that where your goods are 50%, you got 60% money chasing the 50%. That's fine. That's great. But when you get 101%, all this money chasing so few goods because we don't produce, we don't get our GDP going up. And the reason we can't get our growth going up is because, again, we have too much debt. That's when it gets unbalanced, and that's when the market crashes. And the first sign that we saw this week that that was true is right back here again. Right there is when it told us it was out of sync when we saw this guy going straight up, right? At the same time, we saw the amount of housing going up. That's a huge sign. It never does that, never does that. So here's what you got to remember and why the market's getting closer. This is a great signal why the market's getting closer to a crash. But remember the big picture. Every time, now that the Congress has no incentive to curtail their spending, they're spending wild, okay? And the more they're spending, remember what's going to happen. The more the dollar deflates in value, and the people on Main Street, okay, get hurt the most, the working class, because inflation only helps those who have big assets like, metals and plutonium and coins, and that's what they love inflation, because not only they love inflation because they make a lot of money, their assets go up, but the government loves inflation. The government loves inflation because the more inflation you have, remember, their debt, as I told you before, to China goes down in value. So they're paying their debt down, remember. The government ends up paying their debt down with cheaper dollars. Now, that makes China grumpy, but for now, China hasn't sold all our treasuries and all our dollars. So that's it right there. So the reason for that big spike, stock market, housing market, out of sync with for 10 years to get that big spike, big signal, is because of monetization of debt. Simply going in and buying all this debt was created by borrowing money from China or people in way of a treasury. So as long as they keep on moving the debt over to the Federal Reserve balance sheet, the more the dollar's going to keep going down, the more the public is going to get killed, okay? And soon their dollar's worthless, and then all of a sudden what happens, all this spending that brings the market up, all this spending in the market, all of a sudden that inflation turns to deflation, and we'll talk about that next week. Now, it's another big signal. The crash is getting closer and closer. Hope you enjoy this. Please hit like and subscribe, and please join my gang free for 10 days so you know how to short the stock market when the time comes. All right, see you on the charts.